Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. Past guests include Aaron Wynn, owner and operator of Wynn Plumbing in Oklahoma City, Jared Goldfarb, the senior vice president of commercial lending at Bank First here in Tulsa, and Brandon Neth, the co-founder of Evergreen Properties, also right here in Tulsa. Today's episode is brought to you by Keyrenter Property Management. Keyrenter Property Management, we are a full-service property management business helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Ken, you know, since you do this all the time, but lining up contractors to get a make-ready done in a reasonable amount of time after a tenant leaves a property can be very difficult, let alone some of the renovation work that you do in your business. Contractors are busy, the work seems to drag on forever, and all that leads to lost rental income. But at Keyrenter, we line up our dedicated vendors so that turns can happen super quickly and we get more money back into the pockets of our owners, as you do the pockets of your investors. But that's why no matter what rentals you have, single family homes, condos, townhomes, apartments, we have the management solution that you need. Go to keyrenterpmc.com or email us at info@keyrenterpmc.com. Today's guest is Kenneth Gee, and he's lived multiple lives. His first career was in banking. He was a commercial lender at National City Bank, which was later acquired by PNC. His second career was as a tax manager at Deloitte & Touche, and his third career was in forming KRI Partners. And in between, as you'll hear, there was another little career as well. Kenneth has more than 24 years of significant real estate, banking, private equity transactions, and principal investing experience. He's been involved in more than $2 billion of transaction value throughout his career. He also owned and operated several certified Cessna pilot centers in Northeast Ohio, in the Northeast Ohio area, which I guess is a spoiler alert to what I was referring to earlier. And you should visit KRIPartners.com for a whole host of informative podcasts about multifamily investing. There's also introductory webinars that walk you through underwriting deals if you're considering doing this on your own or being your own GP or forming a GP for a syndicated deal. And then there's also stuff on making real estate work for you and your lifestyle and a ton of other great information. Ken Gee, welcome to the show. Happy to have you on.
Thanks for having me, Matt. Appreciate it.
So you've lived like multiple lives. You've had a career as a commercial banker. You've had a career as a tax professional. You've done some private equity transactions, some principal investing, and then you've got KRI. I would love to know the history of how you have lived we should all live multiple lives, but how you lived your multiple lives and how you ended up founding KRI Partners.
Yeah. So that's a great question. So I'll give you the history brief. I grew up in Toledo, Ohio, got my undergrad from the University of Toledo. Then I moved to Cleveland and became a commercial lender for 5 years while I went to school at night at Case Western Reserve to get my graduate degree. Mm-hmm. Got sick and tired of my clients at the bank saying, well, let me talk to my CPA. Let me talk to my CPA. I'm like, man, I want you to talk to me. All right. So I said, all right, I'm going to go be a CPA. So I went to school at night, got the degree, went to work for Deloitte for 7 years and did tons of fun stuff. Like you talked about, a lot of private equity work, M&A work, transaction planning. I mean, a little bit of the compliance stuff, but it was fun. On the tax side, it was fun, as fun could be as a CPA. Well, then, of course, things changed, right? I had a very, very young family. I used to do my daughter's feeding in the middle of the night. Mm-hmm. And I thought it was cool because it's father-daughter time until I realized this sucks. 3 o'clock in the morning is the best I could do for my daughter. That really made me realize, man, what did you just do? Like you thought you did everything right, but what you really did is now you buried yourself in a job that Deloitte's not a bad place. Don't take me wrong. But you work 70, 80 hours a week as a CPA. That's rough stuff. And I didn't want my family to grow up without me being around, right? I'd be working all the time. So I said, all right, I got to figure something out. Well, while I was at Deloitte, that practice, the Cleveland practice it was huge real estate practice, huge. So I had, all the big companies, Jacobs and Zaremba and Developers Diversified, every one of those companies seemed like they started in Cleveland for a city. You probably heard of them. So, but what you did is you got to see, I can't give details, but you can see those people made a lot of money. Man, I need to do this. I need to figure it out. So it took me a long time, but I bought 3 deals in Cleveland, small deals, 28, 24, 22 units. Sold them about 3 years later, made $500,000. And I said, oh my God, this is it. I just made more on the side than I did while I was at
Yeah.
Deloitte, right? I'm
Yeah.
like, this
Yeah.
is silly. So that is what, I made, I got frustrated. And I hear this story, by the way, a lot. A lot of people get frustrated with that experience because they want to hang with their families. So I figured it out. I thought real estate would do it. Now I proved it would work. And so then ended up leaving Deloitte in 2001 on great terms, and just I've never looked back. I just kept doing deal after deal after deal.
I mean, it's clear from that story that you're no stranger to hard work. You're putting in 60, 70 hours at Deloitte. You're over the course of, I presume, a couple of years, you buy 3 separate multifamily deals. How do you find in the early days? Now is different. There are a lot more eyes on multifamily deals, certainly. How did you find those deals in the early days and find 22, 24, 26 unit deals?
I'm going to totally date myself, but my first deal I found was an ad in the newspaper.
Love that.
I mean, they don't even print most of them anymore. So I responded to an ad, and it happened to have been a property owned by a really big owner in Cleveland. And he was a super nice guy. As it turns out, I couldn't have picked a better seller with more integrity. He was a great guy. As it turns out, 7 years before, he bought that property as his first big deal. Now he owns like 10,000 units, right? He's a big guy. But I bought that. I responded to an ad. He could have just destroyed me because I would have been so clueless and I wouldn't have even known it was happening. But he's an honest guy, helped me get financing, took back a note. And then the second deal, I was like, okay, this is starting to work for me. So I just literally hounded everybody up and down the street. Sell me your
Wow.
building, sell me your building.
Yeah.
Finally talked one guy into it. And then the third deal I bought from the development corp. So, you probably know every deal has a story,
Yeah.
but that's kind of how it started.
What were the underwriting mistakes that you made on those first 3 deals that you
Oh,
never made
geez.
again?
I was clueless. I mean, I didn't understand underwriting.
Yeah.
When I say I had a really honest seller, I really had an honest seller, and the lender knew him, and that's how I found the lender. I mean, he really kind of teed this thing up for me, and I
Yeah.
made money on it. Right? He wasn't, he was an honest guy. I mean, his name's Doug. I won't name his last name. Super nice guy. To this day, I haven't talked to him in a long time. But the real mistake I made on that first deal, and this stuff can get scary if you don't know what you're doing. So I bought
Yeah.
the deal. Remember, I'd been a commercial lender, so I understood credit and I understood all that stuff. So the person that was on site was sending me the the applications that she was getting. I'd run the credit report, terrible credit, evictions. I'm like, oh my God, what am I going to do? How am I going to let these people in? Now I got this building and I can't find good people to live in it.
Yeah.
The rents were $415 a month back then. And so I met this wonderful lady named Karen. She toured the property with me. She's like, Ken, you got to fix this place up, man. I mean, the kitchens were from 1930s. I mean, if you ever seen a 1930s kitchen, it's old.
That's the kitchen faucets coming out of the wall instead of coming out of the yeah.
the molded porcelain sinks and
Some of that look is coming back in style.
I know it's everything goes back. Yeah, if I would have just waited, I probably could have.
That's right.
Could have worked. Right. But she said, Ken, I'm telling you, you gotta shine up these floors, you gotta sand the floors, it was hardwood floors. They were beautiful.
Yeah.
Yeah. And she's like, it'll cost you about $5,000. And I looked at her, I'm like, are you out of your mind? Because I just spent every last penny I had just to buy this place. And now you want me to spend $5,000? She goes, look, I'm just telling you, you're going to have to do it. If you build it, they will come. I'm like, okay. So I borrowed that money. You renovated 1 unit. She wasn't wrong. Made it nice, beautiful hardwood floors, newer kitchen, did light fixtures, all the stuff that you would normally do. And then the first app we got was from a Case Western Reserve graduate student. Ding, ding, ding. I'm like, this is where, and guess what my rents were?
$725.
No, close. $599.
Yeah.
This is back in 1997. Okay. This is a long time ago. But I took rents from $415 to $599. So the lesson there was actually a bunch of them. First of all, don't buy these things without knowing what you're going to do with them.
Sure.
Right.
Yeah.
I was really fortunate early on, just did some stupid things and didn't understand. But the other thing I learned from that was you can actually have your rents too low.
Yeah.
Because when your rents are too low, the good people won't even look at them because they'll think, well, that's way low. It must be a dump.
Sure.
And that's what they think. And as soon as, I probably could have spent less and raised the rent. They probably wouldn't have leased because it still didn't look that nice,
Yeah.
but I would have attracted more, better quality tenants to apply. So those are a couple of lessons that I learned on that first deal.
What's the most important factor you consider now when underwriting a deal?
But the numbers have to work. You can't lie to yourself. I mean,
Yeah.
being a CPA, commercial lender. We have underwriting programs that we help people figure out how to underwrite. You gotta know the numbers. You just have to, and don't kid yourself. Don't let the brokers talk you into this and that. You're not buying next year's numbers. You're buying today's numbers. And what I find happen now that 26, 27 years later, we're helping people get in this business. And you see them when they don't really understand the numbers, they don't know, right? They're unsure, they're not sure what they should or could
Right.
do. As
Right.
soon as you teach them the numbers and they really dive in, they're like, oh, no, Mr. Broker, I can't pay anymore. And here's why. And now their confidence level goes through the roof. So that's why I think numbers are the most important. Market's important, neighborhood's important, all that stuff is too. But if you can't figure out the numbers, you're not going to do well in this business.
I mean, brokers are essential. They're the ones that make the deals happen and they push things through. But I look at a T12, a T24, a T36, and it shows increasing insurance costs every year. And then people come and go, yeah, the broker said that I could get a better deal on my insurance and that the cost would go down from $400 a year per unit to $250. It's like, what? Why would you look at the historicals? Why would you think that? I mean, the loss ratio, the loss runs or whatever are what they are. Insurance is going to underwrite it differently, maybe because you haven't had a loss on your record, but the property, had a fire 2 years ago. How are you expecting that things are going to go down? And then, it causes all sorts of confusion when they get into the property and insurance prices go from 400 to 500. Oh, my numbers don't work anymore. Well, you shouldn't have believed the broker when they sold you a bill of goods. But
no, you're exactly right.
It's tough. Tell me, you're a big multifamily guy. You like multifamily. You syndicate multifamily deals. What is it about multifamily investing that makes it more profitable or attractive than scattered site single family, for example?
Yeah, that's a good. So I'll take you back to the decision I made in 96, 95 when I was trying to figure this out in 97. So I couldn't figure out how to run. Well, remember, I was at Deloitte at the time.
Yeah.
There was no way I was going to go to the property and show apartments. I couldn't fix anything to save my life. So I had to have a property big enough that I could have somebody there.
Yeah.
So 28 units seemed big at the time, and it was, all right. But I could afford to have a wonderful lady. Her name was Joyce Thompson. She's no longer with us, so I'll say her full name. She was an amazing lady. She didn't drive. She didn't want to drive. Everything she needed was nearby, and she was kind of the little mayor of the complex. She showed the apartment. She helped coordinate maintenance. She did everything. That was the real reason that I've never actually bought a single family for investment purposes because I couldn't. The other reason now that I've matured more, that I really like some level of predictability in valuation.
Right.
Multifamily is valued based on its ability to generate cash flow. Right. Now, there's a lot of other factors, but it stands to reason that if I can improve cash flow, there's at least a pretty good chance someone's going to be willing to pay me more than I paid. So I like that predictability, right? I like that intentionality, right? We force the appreciation. That's what we call it.
So you're talking about an NOI multiple, a cap rate, in essence.
Well, no, what we're talking about is just improving the cash flow. Right. So if you leave cap rates steady, right? If they don't change,
if your NOI improves at a static cap rate, then you have more value on the property.
That's right. That's right. Yep. Or if expenses go up, that cash flow protects you because you have more cash flow to pay those higher expenses.
Yep. Right. So what do you do to improve cash flow?
We're value add. So we'll go in. Now it's going to depend on the property. Sometimes it just needs management and a little bit of TLC. We bought a property in Winter Haven, Florida. We've owned it for 7 or 8 years. Our renovation budget was $50,000. It was ridiculous.
Wow. Super low.
We've moved rent $625 a month in those 8 years. That's a lot. That's an insane amount of money. We've refied, returned everybody's money, another 100%. I mean, they're loving life. Other properties we buy, they need $3.5 million worth of renovation work because they're run down, they're not nice. And so somehow we're adding value to that property. Either it's through physical improvements or management improvements. Usually it's both. But as you can see, that's a pretty wide spectrum there. It just depends on what that property needs. You would be surprised at how many properties are actually operating under where they really should be in terms of their rent structure. It defies logic because most people will say, well, of course the guy's going to maximize rents, but then they don't always do that.
I guess it stands to reason that if you're going to maximize rents, people are going to have higher expectations. You don't want to go in and fix things properly.
There you
want to
go.
let the maintenance defer and all sorts of other stuff. So you say, I'd rather have lower cash flow and not have the headache. But somebody like you comes in and says, I've got the systems to manage the headache. I've got the systems to do the improvements. Therefore, I'll demand better tenants. I will give them better service. And then in exchange, I'll capture that upside value.
That's right. Yep. And what we usually do is we leave some for the next guy or gal. Now that's critical to our business plan because the next person has to have a reason to buy it. If you eke out every penny, now it doesn't mean you can't sell it. It just means your buyer pool is really shrunk because
you leave a little bit of meat on the bone.
You have to. Yeah.
How does that look like? How does that look? You renovate 40 or 50 units or 15 or 40 and you prove the concept and then say to the next person, do the work and capture the upside.
There you go. Yep. Yeah. Smart. If I have the perfect business plan, I'll go do the exterior, common areas, amenities. I love improving amenities. I love it because it helps us tell the leasing story.
Yeah.
That grabs people, and then do some of the units, and then sell it. That's what we would prefer to do.
When you're thinking about amenity improvements, though, how do you know whether to put in a dog park, a pickleball court, what's fad, what's not, what's really going to drive value? Is it a gym? Is it a cold plunge, hot tub? Like, how do you assess that?
Yeah, that's a good question. I mean, you're going to start at what the property definitely needs. What's really important to me is, so you're going to do different things in different properties. We just closed on a brand new property in St. Pete, 102 units. Well, what we're going to do there is we're just going to finish off the feeling of making that a resort property, right? The way it is situated, we're going to add some AV, some outdoor TV, and a few more things, and spruce up some landscaping, and that place will feel like a Disney resort, right? That's the plan there. But now another property, if it's a B class property, it could be different. What I want is the amenity. I want to give our leasing people something to walk out and say, okay, here's what you have when you live here. Now I tell them to paint a picture. You got dad's watching a football game on the outdoor TV while the kids are in the pool right next to them. Mom's working out. It's lunchtime. Mom or dad goes and cooks on the outdoor grill, which is also right there. Y'all sit at the table at the pool. Then you flip it around. Maybe dad goes and works out, whatever. You see what I mean? Now I'm putting them in that amenity experience. And then we go from there, right? Because a lot of people have dogs. Well, maybe the dog park could be located right next to, because now you brought the dog with you, because kids always want the dog with them. You see how I'm trying to
I'm in. Where do I apply?
That's exactly right. And that's what we do, because guess what? You can't do. You can't put all that in a single family home unless you're rich.
Yeah.
So that's how we pick our amenities. We want that experience for them.
When you've done this, I presume you bought through COVID and have been, before and after. How did you de-risk some of the renovations at the multifamily properties? The cost escalation, putting in the wrong amenities. How do you de-risk some of that stuff to make sure your investment pays off?
What usually happens is what we do is we go through our renovation plan. We leave the least, how do I word this? The least critical ones for last, right? You prioritize these things. Which one will have the biggest impact on value? So if you do start, because this renovation process might take maybe up to a year, maybe more. And if costs get away from you, then you just drop off the bottom of the list, right? Okay. Yeah, it sucks that we can't do it, but it really didn't change. Well, guess what? That becomes part of the meat for the next guy that's still on the bone. So that's how we do that. And that's how we manage it. We're always, and this is a mistake I see a lot of people make, especially when they're new. They go into it, they tell their investors, this is what we're going to do. We're going to do X, Y, Z, and A, B, C, and we're going to paint this green and that red. And then they get into it and they will not change that plan no matter what. And that I watch them do it, and it kills them, because once you get into that property, you just know so much more when it's yours. There's nobody hiding things under the rug. Now you really see what's going on. You need to be prepared to constantly evaluate that plan and change it, right? New people are afraid that their investors will think they don't know what they're doing. But the reality of it is, that is what you're supposed to do.
Yeah.
You've got to change when you learn, when the facts of the situation change, you have to change what you do.
Yeah.
So,
And when you manage you're in Cleveland, you're
mhm.
managing in Florida, how do you manage that geographic disparity?
Yeah, I mean, it's
It's
only
not even the
2 hour.
same time zone, is it?
Yeah. Oh
The
yeah.
same
Yeah,
time
we're in
zone,
the
all
same
these.
time zone. It's a
Okay.
2 hour plane ride. It's a 2 hour
And
plane ride. And I have really, I mean, we have 35, 40 employees. Our regional managers are very good.
yeah,
And look, after, I don't need to be there every week. I just don't, because
yeah,
the numbers don't lie, right? If rents are, you vacancies, you have to have, I mean, there's a lot of telltale signs after you've been doing this a while.
yeah,
Hey, there's a problem. I got to go figure it out, right? So, there was a time when I spent more time on the ground helping our regionals figure that stuff out. They've just matured to the point where, they are ahead of it, right? We're always looking 90 days ahead in this business, and
yeah,
they try to head things off before they become a problem. So it's really not hard. I mean, and who's going to argue with flying to Florida?
yeah. And a place called Winter Haven. I mean, that's
Right. Yeah,
sounds
yeah,
great.
yeah,
Sounds
yeah, I know.
great.
It's in Central Florida. I don't know if you know where it is, but it's
No,
a small town in Central Florida. And man, it just, because everything from the coast comes in from the east to the west and from the south. It all meets in that general area and then goes up to the southeast. So it is a big, really growing area. It's really
yeah,
crazy.
cool. Do you see the same seasonality that we would see in Oklahoma, for example, that leases are popping in summer and dead in winter, or do you
A
see
little
a
bit. It's not as
reverse?
bad though. Yeah, November and December, sometimes a little bit of January are the worst,
Yeah,
because nobody wants to move around the holidays. It
yeah,
doesn't matter where they are, but it's
yeah,
not nearly. I mean, in Cleveland, man, in February, there ain't nobody going outside. It
yeah,
just sucks.
yeah.
And so, no, we don't see that kind of stuff. There in Florida, we're complaining because it's 50 degrees.
Cold.
Being honest,
So cold.
that's what they do. I make fun of them all the time.
So when a potential limited partner is investigating different firms that
Mhm.
they could partner with, I guess in syndicated real estate deals, how do you differentiate KRI partners? What do you think that a potential LP should look for in the investments that they're going to make and the firms that they're going to make? And then
Yeah.
how do you say yes or no to a potential LP?
Yeah, those. So you've actually, you don't realize it, but you just hit my hot button, because I've been doing this a long time, and I watch people, some do well, some not do well when they make their investment decisions. I've come up with 4 rules that I want potential investors to follow. The first one is they need to invest with somebody with experience. It seems obvious, but the
Yeah,
experience is important. I didn't know COVID was coming. I didn't know hyperinflation. I didn't know 500% increase in interest rates. So you need a management team that has enough experience, hopefully through multiple cycles,
yeah,
they can figure out how to deal with it. Then they need a track record. And you think, well, Ken, those are the same, but they're not. The track record that's critical, because you need to have somebody that's gone full cycle with deals. You can buy all the deals you want. The question is, could you sell them and make money? Right. So we've sold 14 of our 19 deals
wow,
and made money, right? So we've proven we've done this. We know what to do. We've taken the full cycle, and that's critical. The third rule is that I want people to make sure that whoever they're investing with is transparent. To give you an idea, if you go to our website, kripartners.com, you'll see our entire track record. We hired a company called Veravest to vet the whole entire track record. I mean, it was ugly because it was 25 years of stuff,
right,
like settlement statements, tax returns, bank statements. I mean, it was no fun. It was very expensive, but it was really important to me that when I said, hey, Matt, here's my track record, you're like, okay, how do I know these are true? Well, somebody's already looked under the hood, right? So
right.
that's transparency. Nobody likes to do that, but I think it's important. If I'm going to ask you to give me 100 grand, you need to know what's really going on here. And then the last thing, you need to make sure that firm's going to put you first as the investor. And the only way to figure that out is to look at the terms of the deal and just ask yourself, is it possible for that sponsor to do really well in that deal and you not? That's the only way. You got to keep that question in front of you as you look through the PPM and things like that.
And what would trigger you? What would trigger the thought, oh, this GP can get rich when I'm not
A
getting
lot of
rich?
fees, a lot of fees, a lot of fees is the first thing. Um, Things like specially allocating depreciation back to themselves and not to everybody in the deal. They do it.
I didn't even know
Um,
you could do that. I thought it had to go pari passu to ownership.
No, not with partnerships. You can do any kind of
Wow.
special allocation you want with partnerships.
Wow.
Yeah.
Wow. So the
There's a bunch
GP
of
could
rules you
actually,
got to follow. Okay. There's a bunch
sure.
of rules. But generally, if I wanted to allocate all the depreciation back to me, I could make that as the term of my deal. I don't think
Wow.
that's fair, but hey, some people do it. I mean, that you asked me for a couple of
Yeah.
examples.
Yeah.
But now the last part of your question, I think, is also important because if you're the syndicator, or we do blind pool funds now, we've done syndications, but we prefer to raise the money first now.
What?
Um,
Oh, blind pool fund
I,
means you're giving me 100 grand. I'm going to go and I'm going to allocate that in a deal, but you don't know what that deal is yet.
yes, that's the way
Interesting.
private equity really works.
Yeah. Right.
Right? True private
Right.
equity. So syndication, remember, you go find the deal,
Yeah.
lock it up, and then go raise the money. Well, if you've ever gone through that experience, it's horrible because you got a very short amount of time to raise a whole lot of money.
Sure.
Well, and you're like in Florida, when there's 20 offers on the same deal, they're all syndicators.
Yeah.
Mr. Broker, I promise I'll raise the money. I know I can. I promise. I promise. Well, now, a few years ago, we said, wait a minute. I'm tired of being just another syndicator and paying up to differentiate. I said, let's go raise the money first. I mean, I know I've done it before. I watched them dilute it at Deloitte for years.
Mm-hmm.
Said, let's go raise the money. Now I've got a track record so they can see what I've done. I'm going to do the same thing now. And so now we have all this capital raised. Now you go to the broker and say, Mr. Florida broker, I've raised 15 million bucks. I need deals. You want to see people work hard? They will work very,
That's it.
very hard
Yeah.
because they know now that whole risk is off the table.
Right.
And it's huge.
Yeah.
It's huge. It's
So-
harder to raise the money because they're trusting me, but they're trusting me anyway. They just don't think of it that way, right? And a syndication, you get to see the building first.
Yeah.
Does that make sense?
Yeah, but I guess it changes the terms a little bit. You're raising the money in January. You don't find a deal till March. Are you paying your pref on
No, we just
that
don't
period?
call the capital. We just don't call the
You
capital.
don't call the capital. Okay, fine.
Yeah,
Okay.
because otherwise, well, I can call the capital. So here's what I would do. We may do this on our next fund. If I do, it's going to go in an interest-bearing account that I can't touch, and whatever interest is earned on that account, we'll do a daily calculation and pay it out to all the investors, so they're not worse off.
Got it.
Right? Because it
Got
just makes you an even stronger buyer. And what you want to do, especially in hyper-competitive markets like Florida, you need to be as strong as you can be. There's, sir, here's my
Sure.
bank account. I
Sure.
don't even have to call the capital. It's here.
Sure.
And it means a lot. Now,
So-
I do want to get to the last piece of that question though, because I think it's really important because nobody thinks about this. When we talk to investors, they're asking me questions that, that's all good. But it's really important to me that I understand what they're trying to do, because I don't want them to have an expectation that this is a liquid investment, that I can get them out for sure in 3 years. I can't do that. So we actually, I don't want to call it vet, but we kind of vet the investors because I'm looking for synergies, right?
Sure.
I want to make sure that we mesh and that you're not trying to do one thing and I'm trying to do another with the investment, because we know that's not going to end well. So that's, I just wanted to answer that last part of your question.
Yeah, so you want to make sure that time horizons are
Yeah.
known. It could be 3 years and it could be 7 years. We're going to get out of this
be
deal.
Longer than that, because here's the deal. In our business, as long as you don't lose a property, usually you just have to wait out anything that's tough in the market. You just need time. So
Right.
just don't over leverage the property. You won't lose it, and you'll probably be fine. But you need an investor that understands that that's a possibility, and that's what we try to do.
Speaking of over leveraging a property, what's a comfortable range of debt to asset value in your mind?
Right now we're at about 60 to 65, maybe 70. I haven't done 70 in a while, but it's 60, 65.
Even when interest rates were lower, you're at 65?
Yeah, we did a bridge loan that was more, but we paid that out quickly after like 11 months.
Yeah.
Yeah. I don't like variable rate debt. Remember, I lived through 08, 09.
Yeah.
And so I know what ugly looks like in the debt market. So
Yeah.
we're really careful about managing our debt.
Yeah. Where do you manage? Is it all in Florida, everything that you're acquiring now?
Right now, yeah. We'll go anywhere in the Southeast. We're in the process of, continuing to grow. I'm just slow and deliberate. I'm not going to I call it jab. I'm not going to go find a deal in one market and go find a deal in another market, right? That's not how you make money in this business.
Yeah. How far geographically do you spread in Florida, and are you able to take advantage of synergies of property managers, maintenance teams, that sort of thing between properties?
Yeah, a little bit. I mean, we're in Tallahassee. We've been in Jacksonville. We're in Daytona. We're in Winter Haven, which is Central Florida, Tampa, St. Pete, Bradenton. So we're kind of
markets,
all over. I mean, it's a big area, but it's not that hard.
And are you making a decision between cash flow on properties and potential appreciation, or is it all you underwrite for solid cash flow?
We do both. Yeah. So the reality of this business is, well, now in the markets that we're in, we need some cash flow because you should be paid to turn, give us your money. We're looking anywhere from 4 to 6% is what we're looking for. And then, but the real money in this business is in the appreciation,
Right.
right? We grow the cash flow. So cash flow is minor, but it's really not. It actually drives the whole bus. It's kind of weird when you think about it, because that cash flow improves the value. And so if you're leveraged 40 to 60, right? If you're 60% leveraged, if you did the math on a 100 unit property and if you raise rent a couple $100 a month over a 5 year period, that's basically a double on your equity.
Yeah.
If you do all the math. I won't do it for you here.
That's the argument in favor of levering up as high as possible.
Yeah, but I wouldn't call
you don't want to lose the property.
I wouldn't call 60% over leveraging, right?
Yeah.
I don't want to. Yeah.
I do single family, not multifamily, different world, certainly. But I'm like, and I argue with my business partners on this stuff when we buy in partnerships. Like, I want to be at 100% debt to equity. I want to be like all the way up, and then I want to buy as many properties as possible so that you're talking about the cash flow smoothing over time is cash flow is smooth over multiple properties. That if one is vacant, you pay from another. But then your return on equity looks really, really good because if your denominator is zero, then your numerator is infinite, and then the equation is infinite. But you can easily get over leveraged, and if markets turn, boom. And the problem with my generation of investors is that we've never seen a significant downturn in the market. So you guys have more wisdom. Your generation, and you're only a few years older than me, probably, but your generation has more wisdom and has seen more cycle than our generation. So we get a lot of very, very aggressive investors in my generation.
Yeah, no, you're right. Yeah, you're right about that.
So you talked about the catalyzing event in your investment journey or your career journey, and that was feeding your daughter at 3 o'clock in the morning. For those that are looking to start their investment journey, that are a little bit afraid to put their cash to work, or they like the stock market. Well, the stock market's seen a good return over the last year, so whatever. But they maybe don't want the variability of the day to day and clinging to their iPhone to check the variability of the daily markets.
Yeah.
Like, if they don't have a catalyzing moment that springs them into action, how do you encourage them to start investing?
Yeah, I mean, it has to come from within them, right? They have to have a reason. That catalyzing event that you called it, something has to happen to them, right? And for me, it was just I didn't want to. As it turned out, my daughter played AAU basketball. I traveled all over the eastern half of the country on her stupid AAU games, right? We had a blast.
That's awesome.
Right? My son played baseball. He was a pitcher. I would have missed all that crap, right? That for me, that's what it was. The other catalyzing event for a lot of people. And I talk to a lot of people getting into this business because we have a whole investor education side of our business. And so their frustration is similar to mine. They want to take control of their life. The other number one person is somebody that flips houses, and they make money doing it, but now they want to grow long-term wealth. So that's how they flip into the multifamily. Most people, well, the third bucket is people who they're doing well, but if they wanted to go charter a yacht for 50 grand for a week, they probably can't figure out really a way to justify that. That will be painful, right? Well, see, now I'd rather be in charge of my own financial future. I really would. So that if I screw it up, it's on me, right? I was always deathly worried because I'm not really good at corporate politics. I'm just not so good at that, right? That if you frustrate the wrong person, basically, if you piss off the wrong guy or gal, your career could be stopped. You don't even realize it. You're still working like a dog, and you're not going anywhere. And that really, really worried me. So that's a big part of it for a lot of people. They'll get canned. They'll see their friend get canned, and they've been there for 15 years.
That's a catalyzing event.
That is. I mean, there's a lot of things. There's a lot of things that happen to people. Here's the thing that most people don't realize. They think it's a scary thing, and sometimes it is, but they think they need to quit A in order to do B. And you don't need to do that in real estate. I didn't do it. My first 3 buildings, I still worked at Deloitte. I mean, that was a lot of demands on my time. but I could do it a little bit at a time. That's what's really nice about real estate. You don't have to go out and buy 800 units at once, right? Even if you could buy a 20 suiter and then buy a 30 suiter. Do this thing slowly so that you kind of ease your way into it. That's how I encourage most people to do it. Because what if this, you're not going to get rich in real estate overnight. Maybe you do. I don't. This just takes time. But man,
Yeah.
when it stacks up, man, this graph is just, it just climbs very quickly. You just have to give it time to do that.
Yeah. And even that, I mean, your story was one where you were the GP from the beginning, but if somebody has 25, 50, $100,000 that they want to put to work, they don't have to even work on the weekends. They just send you a check and they're done. But
They do.
my question
Yeah.
to you is what sort of check sizes do you generally accept from your LPs?
Yeah, usually the minimum's 100. It's usually somewhere between 100 and a million. The average is probably close to 250, something like that. I haven't calculated the average on the last one.
So really, just as an investor is vetting you, and you say that one of the criteria is that they be that the investment partner they're going to choose has some experience and a track record. Sounds like the average investor might also have some sort of track record. They might have joined some of their friends in doing a smaller deal and cut $25,000 or $50,000 checks. By the time they get to you and they're ready to cut $100,000 check, they may be cashing out the 401k and self-directed, or they may cash out a regular stock portfolio and cut you a check, but they may also have invested in other things and not be totally green.
That, no, you're right. You're right about that. We have a lot of when we talk to partner or potential investors, I always encourage them, look, if you haven't done this before, I want you to pick 2 or 3. I don't know, it depends on how much money you have. Put a little bit with us, a little bit with somebody else, a little bit with somebody else. And then don't spend it all, but do that and watch and sit back and experience this thing, right? And you're gonna very quickly figure out, wow, I like what these guys are doing. Wait a minute, these guys haven't even called me since I wrote the check. What the hell? Right? I haven't heard from them. They don't return my call. That stuff goes on in this business.
Yeah.
So that's why I want people to kind of feel their way around and follow those 4 rules. If I see these investments go wrong, it's because they broke one of those 4 rules. They just do almost every single time. And usually it's more than one. And it's because they get FOMO. They're fear of missing out. They're like, man, I gotta get in. I gotta get in. Now we'll let people in for less if that's what it means, because I don't, here's my message. Matt, if you're going to invest with me, I do not want you laying in bed awake at night, kind of having investor's remorse, right? No way do I want that. I would rather have you in at a number that you're really comfortable with, and there'll be another deal. Just chill. Let's do this the right way, because I'm not transactional. I want you around for the long term, and most of our people do stick around.
Interesting.
That's the right way to treat people. That's what you should do with people, right? But so many people don't do that.
In a I wouldn't say a perfect deal, but in an average deal, once an investor writes you a check, they stroke that check and they mail it off to you, or they ACH or they wire it to you, or whatever. How often should they expect to hear from you?
Yeah. So first of all, we are updating them regularly through the portal. So at a minimum, like the deal that I talked about, everybody's got their money back and all that. They hear from us quarterly.
Yeah.
I send them statements. If they call me, they all have my cell phone number. I call them back. There's no reason not to. They can email me anytime they have questions. They'll even, hey, everybody vacations in Florida. Hey, I'm on vacation with my wife. Can we swing by the property? Yeah, when do you want to go? I'll have the manager show you around. We're totally cool with that.
That's awesome.
That's what you should do.
People want to see the assets they've invested in.
Yeah, and they want to be proud, right? They want to be able to show their wife, their kids, their family.
Yeah.
Look, we own part of this, it's a cool thing. It is cool.
Yeah.
So you want to at least talk to them quarterly, and we send them, usually it's 4 to 6% is the cash flow distribution. And we send that quarterly. Along with, we send them a P&L, a balance sheet, the rent roll, and then we write up a narrative on each property. What's going on, right? It just depends on the property. Maybe we're in the middle of renovations, whatever. We're thinking about putting it on the market, and here's what we're thinking, and here's why. Whatever it is that's going on, we want them to know about it.
Yeah. A big portion of your website, KRIPartners.com, is devoted to education for the growth and betterment of potential investors, people that are syndicating, how to underwrite deals, how real estate fits into your life, et cetera. What do you do to continue your personal and business development?
Oh, I just go, I'm constantly learning. I'm constantly reading. I'm trying to put myself around people who have even gone further than I have in this business and in other businesses. that's really important, right? Because I mean, apartments are a business. What I'm doing is a business.
Right.
So whatever business you're in, I'm sure I could learn a lot from you, right? I know what you do, but my point is, if you own a law firm or you're a physician, I'm still learning from you. So I just try to put myself around people that I can learn from, and you're going to learn from everybody all the time. You just will.
Yeah. Can we touch for 1 second? Last question. I want to know a little bit about your Cessna pilot centers in Northeast Ohio. I'm a pilot.
Yeah.
I love general aviation. Yeah. Are you a pilot, or was it a business?
I am. I mean, once you're a pilot, you're always a pilot. I'm not current. So
Okay.
So when I was at Deloitte, because I didn't have enough to do, I wanted to learn to fly. And so the key tower was where the building where my office was. Less than half a mile away was Berkeley Lakefront Airport. And so I thought, I want to learn how to fly. So during my lunch hour, I would go to the airport and learn to fly.
Wow.
And they had one new Cessna 172R, if that means anything to you. Basically underpowered 172, but it was the only brand new airplane. I'm like, I ain't flying anything but that plane. Right. They had all this other stuff.
What year was this? 99?
It was right around there. Yeah, probably.
Okay, so you were flying an old six pack. There was no Garmin G1000.
I had steam gauges. Yeah, I had steam gauges. Yeah, they were just coming out with the glass stuff. Yeah.
Okay, cool.
So I thought, and all the other planes there were old, shag carpet. I mean, nothing worked in them, right? I mean,
but a 172R means that it was retractable?
No,
what does the R stand for?
They have an R and then an S. The R, this is funny, I still know that. The R had a 160 horsepower engine. The S had 180.
Okay, underpowered.
And it mattered. It mattered a lot in performance, right?
Yeah.
So I thought, so I learned to fly there. The funny thing is, I'm blind in my left eye, so I'm monocular vision.
Got it.
I can see okay, but there's different rules, right? So I got my pilot's license, passed the medical, did everything, the full check ride. Then I got a letter from the FAA. You get to fly with one of our medical examiners. I'm like, dude, I don't care. You're flying with an examiner. So I got the benefit of 2 check rides, not just one, but 2.
Cool. That's extra safety.
Fun. That's right. So I remember we're on short final. He pulls back the throttle. He's like, okay, you have an engine out. And by the way, what does that sign say over there on the freeway? Because there's a freeway right next to the airport. So I'm reading the sign, short final, trying not to stall. And then he says, all right, do you see that plane up there?
And you said,
like, I don't see a plane, man. But there's a plane there. I don't see it. I guess I'm going to fail. He goes, good, because I wanted to see if you were going to lie to me and tell me you did.
Yeah.
I'm like, man, you're a dog. You're horrible, man.
Sly fox.
So I passed that. So then I thought, man, this is cool. This is really cool. But you're downtown Cleveland. At the time, downtown Cleveland was kind of thriving. Mm-hmm. And people would love to come down here and fly, right? And the people that have the money are there.
Yeah.
So I said, I'll buy the school from the pilot, the CFI that owned the place. Didn't pay much for it. Replaced all the planes with new planes. Did really well. 9/11 was part of that experience, and sold it a couple years later. So I kind of did both for a while. But yeah, that's how. So I was at Berkeley Lakefront, Cuyahoga County, and Akron Canton. So when you think about all these lives that you talk about, commercial lending has had a huge impact on how I run properties. It really helped me understand numbers. Being a CPA has certainly helped. Tax side certainly didn't hurt. Being the private equity guy, all these things, and then operating a decentralized Part 141 school. I mean, that teaches you how to run a decentralized business, which is exactly what I'm running right now. So all of these things kind of come together and actually serve me well now that, you fast forward 25 years.
I'm gonna Google Part 141. I know 91 and 135. I don't know.
Well,
Part
most people are 131, 135, or most people are 91.
91. Yeah, that's
135 is a charter.
Commercial. Yeah.
Yep. And then Part 141 is basically a certified pilot school under the FAA. So we got the benefit of having the FAA inspect all of our books, our records, our processes, our airplanes. It was a lot of fun.
And then so you sold and serviced Cessna, Textron.
I sold Cessna. I sold my pilot centers to somebody else.
But at the pilot centers, you actually sold Cessna airplane, or you just sold the services?
Yeah. So we covered Northern Ohio. The true dealer was in Cincinnati at the time. And he's like, look, cover Northern Ohio. We sold a whole bunch of airplanes. What we did is we sold a lot of them and they leased them back to the school.
Yeah.
That was a big deal. You probably are familiar with that.
Yeah. Awesome.
So I was only a private pilot, and I don't fly anymore, mostly because of the monocular vision thing. It's hard to see. The hardest time to see an airplane is when it's coming right at you. You know.
Yeah,
that.
I bet. Yeah.
That is.
Luckily, the G1000 and ATC will give you a heads up, but it can be. Yeah. I sent a message. I called where was I coming out of? I can't remember where I was coming out of. I had a buddy in the front seat, and I had like 12 o'clock and 15 miles, and I had a plane coming head on, same altitude. So I say ATC 350 whiskey. I've got on my scope, I've got a plane 15 miles out. And he goes, how far did you say? 350 whiskey, you know, whatever.
Yeah.
Denver Center 350 whiskey. How far did you say? I said 15 miles. He said, if it's a mile, let me know. If it's 15, I got you covered. And I was like, I felt kind of foolish. I was also like, ATCs, they're usually always super nice. This guy was kind of a jerk, you know? I was like,
yeah, I'm up here. Miles. Yeah, it'll take you an hour to get to him.
Yeah, I'm like, I'm up here with a bunch of other planes. I want to make sure you're with me, but he was not having it. So, anyways,
yeah, what is you said on your scope. So when I flew, TCAS was a new thing, right?
Yeah,
collision avoidance.
Yeah,
all that stuff was just coming out. In the cockpit weather, all that stuff was just coming out.
It's amazing where it is now.
I didn't have a scope.
Amazing where it is now.
I had eyeballs. That's what I had.
Kenneth Gee has lived multiple lives as we've talked about. His first career was as a commercial lender at National City Bank, which was later acquired by PNC. His second career was as a tax manager at Deloitte and Touche, and his third career was in forming KRI Partners, where he currently is. Kenneth has more than 24 years of significant real estate banking, private equity transactions, and principal investing experience. He's been involved in more than $2 billion of transaction value throughout his career. The fun note that we just discussed is that he's owned and operated several certified Cessna pilot centers in Northeast Ohio, in the Northeast Ohio area. I would love for you guys to visit KRIPartners.com for a whole host of informative podcasts, introductory webinars that walk you through underwriting deals, making real estate work for you and your lifestyle. And there's a ton of other great information on that website. Ken, we appreciate so much you being on the podcast and teaching us all about what you do.
Well, thank you for having me, man. It's been a lot of fun. Thanks.
Been a pleasure. Take care.
You bet.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.